Today we're going to be covering the recently proposed 50-year mortgage term. I'm going to explain a little bit about it and who exactly it benefits. So just recently in the States, there has been a policy announcement or a policy suggestion, recommendation rather, whereby a 50-year mortgage term has been introduced as an idea to run with. And it's quite fascinating when you look into it and some of the details around it. So I wanted to cover it today in case you're a bit unfamiliar with how it might work and who this policy would benefit in reality. So first of all, currently in today's society, in today's system, in the States and similarly with Australia. So while this video covers the American side of property and the mortgage system, it also relates very closely to Australia. There are a few differences, but none that really affect our discussion on this. So currently, the average mortgage for a residential home in the United States is 30 years. And so I want to give you some really quick numbers so you can think about the amount of interest that a standard mortgage would accrue. So again, using really round numbers here, if you were to buy a home for $500,000 and you had a 10% deposit, which is $50,000, then you would obviously have to borrow the other 90% of the value. So that's $450,000. To do that, you would go to a bank and you would borrow the money against the value of the home. And so on a 30-year mortgage term, you would be paying back approximately $970,000. So just short of $1 million for that $450,000, which is obviously more than double the amount that you've actually borrowed for that property. So, which is why I often tell people, as a side note, I often tell those in my network that buying a property, you don't actually make money if you're taking out a mortgage against it. You really don't make money until it doubles in value. However, that's how the standard mortgage works on a standard, albeit maybe on the cheaper side, home currently. So let's take this same scenario of the $500,000 home and let's overlay it over a 50-year mortgage term. Having the same amount of deposit, 10%, $50,000, borrowing the same amount at $450,000. Over the life of the loan of the 50 years, you would actually be paying back, the borrower would actually be paying back $1.3 million, which is almost 3 times the initial amount of the borrowed value of that property. But one of the details around this that is interesting is because it's a 50-year mortgage as opposed to a 30-year mortgage, the interest over the life of the loan is obviously much higher, but the repayments on a monthly basis are much lower. So with that same property of $500,000, if you were to take the mortgage period from 30 years and extend it out to 50 years, on that 50-year period, you would be paying $400 a month approximately less than if you had that 30-year mortgage term. So on paper, the mortgage actually looks more affordable, which leads us into who actually benefits from a 50-year mortgage. So, and if you have borrowed money previously to buy a home, you would be familiar with this. But if you are looking to buy a home and you walk into the bank and you say, hey, I've got this amount of money saved up and my income is this, then the bank will look at all your assets and everything that you have generating, and they will determine how much you can afford to pay back. They don't look at how much you can afford to borrow, they look at the amount of money you can afford to pay back with relation to an interest rate. So if you think about it from that perspective, if you lengthen out the mortgage term, you can actually still repay the same amount, but the property that you can afford, its value would be much higher. So when you understand that, you understand that people entering the market on a 50-year mortgage would actually be able to borrow more money i.e. buy a more expensive home. Which is who this benefits, is the person selling the home. So if you are the market, if you are the house, if you are the vendor or the person selling the house, you understand very clearly that the person borrowing the money to buy your house has more money in their back pocket. So what does that do to the market value of your home as the seller? It increases the market value of that home. So what we will see if this 50-year mortgage is actually introduced is we will see the market value of property rise. So who this benefits is those that already own property. It's probably no surprise to you that the person that introduced this policy idea is actually a very successful property investor. He's a property guy. So that would make a lot of sense. The other interesting point about this that I want to point out, another cohort that this benefits is the banks. Now, obviously we would understand that this would drive up or increase the amount of borrowing or borrowers, and therefore that's good for the banks. But if you look at it from a slightly different angle, the major banks at the moment are in a lot of debt. In fact, a lot of them are in more debt than they actually have debt owed to them. So I just want to use one bank because it's familiar to most people and it's one of the majors, and it's JP Morgan. So currently, towards the end of 2025, JP Morgan has almost $5 trillion in debt sitting on in its liabilities on the balance sheet, which is much more than it has in assets. That 5 trillion is up from 5 years ago, where it was sitting at around $4 trillion. So over the past 5 years, JP Morgan has increased its debt, increased its liability by 25%. That is massive. And it affects the valuation of that bank. Absolutely massive. So for those of you who are studying accounting or are an accountant, you would understand, or for those of you who aren't accountants, may not understand, that on a balance sheet, if money is owed to a business, that business sees that money as an asset, because in the future at some point that money will be returned to them. On the flip side, if that business owes money, that owed money sits on their balance sheet as a liability. And that is for the simple fact that in the future at some point that business is going to have to pay that money to its creditor. And so it's seen on the balance sheet as a future liability and therefore a current. And so it's really interesting to note, with the banks in such high debt, what this allows them to do is transfer the risk, which is liability, transfer the liability from their balance sheet to the borrower's balance sheet or the borrower's budget, because most of these borrowers for residential properties probably won't be businesses, they'll be mum and dad investors. And so the second group that this policy benefits is those lending the money. Obviously, because they make money on the borrowing, but what they actually do as well is they're removing a lot of the liability off their balance sheet, which as well adds value to their business on top of selling more mortgages. So that kind of wraps it up with the 50-year mortgage. It is actually ludicrous, absolute ludicrous. And if you are somebody who's considering, in the United States, considering this, if the policy is to be introduced and successful, if you are considering taking out a mortgage over the next 50 years of your life, regardless of what stage of life you're in, I would urge you to do some serious research. I want you to research opportunity cost, Google it, spend 3 hours looking into opportunity costs and how it might apply to your situation, because I can tell you right now, it doesn't matter what situation I am in, I would never, ever go into a 50-year debt structure. Not a chance. But that's up for you to decide. I'm not going to tell you what to do and what not to do. But if you are in the market of a 50-year mortgage, I would seriously do some research and consider this decision. This has been Money Media, and I have been James, and I'll see you on the next Money Media video where we cover all things business, finance, and economics. Take care.